Okay, so here's the deal. I have a lot of credit cards and almost $1 million worth of mortgage debt split across multiple properties, which might make you question how good of a credit score someone in this type of situation might have. But despite all of this, I actually have a credit score above 780, which is considered to be in the range deemed as excellent. So in today's video, I'm going to explain to you how you can also get a great credit score in less than 6 months. That'll allow you to qualify for the loans that you want at competitive interest rates. All right, so you're probably familiar with your credit score, but if this is new to you, you can think of a credit score as essentially a numerical representation of an individual's credit worthiness, basically indicating the likelihood that they will repay borrowed money or fulfill other credit obligations. So it's essentially a measure of risk that lenders use to evaluate the potential risk of lending funds out to a given individual, which of course isn't a perfect science, and that's why many lenders will also require checks of income, other debt values, and obligations before issuing out a loan. So it's for this reason that maintaining a good credit score is going to be important, as it can affect your ability basically to access credit in the first place, as well as the interest rates that you're offered on said loans, and even impact other aspects of your financial life, such as renting an apartment or even obtaining insurance policies. Now, in Canada, credit scores are calculated by credit bureaus and typically are going to range from 300 on the low end to 900 on the high end, using various factors to make up the score, each factor coming in at different importance and therefore weighting in the calculation, which are broken down as follows. Okay, so coming in as the most important factor, we have your payment history at a weighting of roughly 35% of the score, which is the record of your payment installments on credit accounts, such as your credit cards, other loans, and mortgages. So consistently paying your bills on time will be the most important factor in improving your credit score and helping it maintain higher levels, both for the long term, but also in the short term. And making even a few months worth of credit payments on time will have a very positive impact on your credit score. And this is also why missing payments of any debt obligations by even 1 day can tank your score by multiple double digits at once. So if you aspire to increase your credit score, make sure to just set reminders or automatic bill payments towards your credit card, your student loans, personal lines of credit, and any other payment so that you're always on time. And this will also avoid you paying any further interest, which of course you want to avoid as well. The second most important factor in calculating your credit score is your credit utilization ratio at a weighting of roughly 30%, where this is the ratio between your outstanding credit card and line of credit balances relative to your total credit limits, where keeping this ratio on the low end, ideally below 30%, demonstrates responsible credit usage and will therefore positively impact your score. For sake of example, if you only have one single credit card with a $3,000 limit, well, chances are your overall credit utilization will be higher as you make regular everyday purchases throughout the month, where a $2,000 balance when your credit is reported would equate to 66% credit utilization, which is considered high. On the flip side though, if you have a $10,000 credit limit, that same $2,000 balance would mean only 20% utilization, which is generally considered to be within optimal levels. Now, one of the ways that I personally keep credit utilization on my credit cards low is by having just high limits. Pretty straightforward, but keep in mind, this isn't necessarily feasible if you're 18 and new to the game, but over time, as you make your payments on time and are considered to be a good borrower, you'll probably be offered credit increases by your current credit card providers, which can be accepted to easily increase your limit. I personally always accept my pre-authorization credit limits by American Express, Visa, and any other provider, not because I'll be putting, say, a $40,000 balance on my card, but rather because my everyday spending now utilizes a much smaller percentage of my overall credit. Otherwise, you can also open a new credit card every 6 to 12 months to both, yes, take advantage of sign-up bonus perks, but also increase that overall credit line amount, which should therefore then decrease your utilization if you keep your spending in check. And by the way, if you're interested in some of the top credit cards that I recommend here in Canada, I have a bunch of videos that you should check out on my channel. Okay, moving into the third factor that impacts your credit score at a weighting of roughly 15%, we have the length of credit history, which basically just considers, well, how long your credit accounts have been opened, established, and in good order, hopefully, where a longer credit history generally reflects a larger degree of stability over time, otherwise they would have been closed down. So this one is quite simple and there's not much that you can do to actually improve your length of credit history other than holding on to your oldest credit cards and waiting for this value to increase. However, one thing to keep in mind is that your credit history length is generally an average of your various credit lines. So if you have, say, 5 credit lines, well, your history will be the total length of them all together divided by 5, which is why if you have older credit cards that you got when you were, say, 18, well, if they aren't costing you anything and you can just throw up a few small charges each month on them, you're generally better off holding on to them. For example, I still have a couple of free Visa cards that I've had for over 9 years at this point. I don't really use them, but keep them active anyways, as they're by far my oldest credit lines. Next up, we have the types of credit used, which accounts for roughly 10% of your credit score's weighting. Now, diversifying your credit portfolio with various types of credit products can yield positive effects on your credit score, where this strategy will entail managing a mix of credit instruments, including credit cards, installment loans, mortgages, and possibly other forms of credit, such as, say, a car loan, if you have access to them. And the logic behind this is quite simple, that by incorporating different types of credit, you can demonstrate to creditors and credit bureaus your ability to manage diverse financial responsibilities effectively. For example, I personally have 6 different credit cards, multiple mortgages, personal lines of credit, and a few other forms of credit, which demonstrates a range of credit utilizations. So I don't recommend, just jumping into new credit lines for the sake of it. But again, this is something that can be worked on over the years as you acquire more assets and debt along with them. And anyways, for increasing your credit score rapidly, this isn't going to be the most influential factor. Hey, quick break here before looking at our 90-day game plan to improve your credit score to talk about today's video sponsor, Equifax Canada, with Equifax Complete Premier, which is Equifax's most comprehensive credit monitoring and identity theft protection product. Now, you're probably already familiar with Equifax as being one of Canada's main credit reporting bureaus, but did you also know that they offer top-of-the-line credit report monitoring to help you spot signs of identity fraud as well as identity restoration services? Well, I think it's safe to say that in today's world, being alert to cybercrime and identity theft should be top of mind for anyone who values their security and privacy online. And this is what Equifax Complete Premier is here to help you accomplish by not only providing you with a daily updated credit score, which is fantastic, but also by monitoring your credit report for key changes that can help you spot signs of fraud, which can often pass under the radar for individuals until it is too late, unfortunately. So not only does Equifax Complete Premier help you spot signs of fraud as a proactive, preventative measure, but it also has your back in case you unfortunately do find yourself in a position of identity theft by offering ID protection and restoration services, where in the unfortunate event of identity theft, Equifax provides a dedicated identity restoration specialist who will work hard on your behalf to help restore your identity. What's more is that this service includes up to $1 million in ID theft insurance to help cover the costs associated with restoring your identity. So in today's digital age, protecting your identity is non-negotiable, and Equifax Complete Premier is here to help you accomplish this task with a top-tier credit monitoring and identity theft protection service. And if you want to safeguard your financial future, sign up for Equifax Complete Premier using the link down below in this video's description, as well as pinned in the top comment below the video. Okay, back to the video. I've gone ahead and created a 90+ day game plan for you to follow if you're looking to increase your credit score. Here's what that looks like. So days 1 to 15 are going to be known as the assess and strategize phase of the blueprint. So step 1 here is going to be checking checking your credit report, where you're going to look to obtain a copy of your credit report from both credit reporting bureaus here in Canada, reviewing them carefully for any errors or any discrepancies that you might spot on them. Step 2 is then of course to dispute said errors. So if you do find any inaccuracies, dispute them with the credit bureaus to have them corrected or removed from your report accordingly. And by the way, these two steps might seem like a no-brainer, but they are actually extremely important as the first steps in improving your credit, because there could very well be some discrepancies. For example, I have had properties on my credit report that had the wrong address on them and so forth. So making sure that everything is up to date is going to be very important. Now from here, step number 3 in the first phase is understanding your score. So familiarize yourself with the factors that are influencing your credit score. We looked over all of the 5 main factors earlier: payment history, credit utilization, and so forth, but these are going to impact your credit score in a different manner depending on what your finances look like. So get familiar with what your credit score and report are looking like and impacting your financial health. Then from here, step number 4 in the first phase is creating a budget. So establish a budget if you can to ensure that you can make those timely payments on all of your existing credit accounts and bills. And then finally, you could consider consolidating many loans together. So if you do have a lot of debt that's, say, spread out all over the place with high balances and that you have a hard time managing, you could consider consolidating your loans by combining multiple debts all into one single, more manageable loan, often with a lower interest rate. Now, this strategy aims to simplify debt repayment as a whole, reduce your monthly payments, and then potentially save you money on interest over time. And then by streamlining various debts all into one, it can sometimes provide greater financial clarity and control over the repayment process for some individuals, ultimately working towards a more secure financial future. That's always the goal here. However, do keep in mind that this could very well impact your score in the short term, but if it does help you, make all of your payments on time, then in the long term, this will still be beneficial. But if you're able to just stay disciplined towards paying down all of your individual debts, starting with the highest interest rates when first, typically, well, that would be the best course of action. Moving into phase 2 here, from day 16 to day 60 are going to be known as the take action phase of this blueprint. So step number 1 here is of course going to be paying those bills on time. So ensuring all of your bills, including your credit card bills, loans, and utilities, are all paid on time to maintain a positive payment history. We learned earlier that this accounts for around 35%, so very important here. Step number 2 is going to be attempting to reduce your credit card and other loan balances as much as you can, really. So aiming to lower your credit card balances, particularly if they're close to or exceeding your credit limits. Ideally, keeping your credit utilization below that 30% as mentioned earlier. Step number 3 here, avoid opening any new accounts during this phase here, right? So minimizing new credit applications during this period specifically to prevent additional hard inquiries that could negatively impact your credit score in the short term. And then step number 4 in phase 2, you could consider some credit building products as well. So if you do have limited credit history or poor credit, exploring certain options like secured credit cards or credit builder loans to establish or rebuild credit could be a course of action that you might want to explore. Moving into phase 3 here, so from day 61 to day 90, this is going to be known as the monitor and fine tune phase of the blueprint, with step number 1 being monitoring your progress. So it's very important to regularly check your credit score and then monitor once again any changes in your credit report to track said progress. And once again, if you were to sign up to Equifax Complete Premier, well, they are going to provide you with a credit score every single day. Step number 2 in this phase is maintaining good habits, of course. So continuing to make timely payments and keeping those credit card balances low to sustain positive momentum in paying back any credit that you owe. Step number 3, reviewing your credit limits. So you could very well contact your credit card issuers to request increases in your credit limits at this this point, which could help decrease your credit utilization ratio. Remember that. From here, reviewing your credit mix. So if possible, you could consider diversifying your credit mix by adding different types of credit accounts, such as installment loans or different types of lines of credit. But once again, this would be a longer term strategy, and you need to make sure that each extra loan that you're taking on is very well manageable in your budget. And then phase number 4, so days 90 and beyond, is going to be known as the long-term maintenance phase, which doesn't really ever end. Step number 1 in this phase is automating your payments. So set up automatic payments for your bills and credit accounts if possible, and this is going to ensure that you never miss any due payments. Step 2 here, regularly review your credit score, but also your report. Make it a habit to review your credit report at least every couple of months. I like to look at it once a month so that you can catch any errors or signs of potential identity theft even. And again, you can do this with Equifax Complete Premier. And from here, be patient. So building good credit takes time. Remain patient and committed to those financial goals. So all that to say, by following this 90-day plus game plan and adopting healthy credit habits for the long term, remember this is always the key element here, long term, where you can make significant strides towards improving that score and achieving greater financial stability here in Canada. So thanks a lot for watching, and make sure to also check out my other videos that I have on the channel covering some great Canadian credit cards for travel, groceries, and other cashback rewards if you're interested. And also don't forget to check out Equifax Complete Premier, top link down below in this video's description. Thanks a lot for watching, and I'll see you in the next one.